Hey, good morning. Welcome to the Victor H Investing channel. This is the live stream covering Friday, May 24th. The stock market's been open for about 30 minutes and stocks are up in trading this morning. It has been an up and down week. We had a fairly big down day yesterday. We saw a lot of stocks sell off. It was interesting because yesterday, at the same time that the stock market sold off on, I think, worries that inflation is going to be higher and the Federal Reserve is going to be keeping interest rates higher for longer. Nvidia announced really positive earnings and their stock really rallied, but it wasn't enough to keep the rest of, I guess, the index to go up higher. This morning, stocks have opened up higher. Will it fade? I don't know, but we'll see what happens. We are sitting on a Friday before a 3-day weekend in the US where Monday stocks will not trade. The stock exchange will be closed on Monday. So they're going to give the computers a day off because everything's electronic now. I don't understand why you have to turn off the computers on a day, but it is what it is. So I wanted to look at a couple of things just to get started, and then we'll jump into a couple of topics that I wanted to cover. One being, where can we find discounted stocks? Where can I find discounted stocks? And I'll take you through kind of a stream of thought there that goes into sectors and industries to see where can we find the stocks that are going to rally in 6 months, 12 months, and so forth. Now, the one theme that I've seen for about a year and a half is the Russell 2000, which is made up of the smaller companies, has not been keeping up with the S&P or the NASDAQ, and it continues. If you look at the last 5 days of trading, the Russell 2000 is down 2.69. The Dow also is having a bad week. It had a really bad day yesterday. And the NASDAQ, it's a little bit negative this week. If you look at the last 5 trading days, over the last month, the S&P is doing quite well, up 4%. The Russell is doing okay. It's doing 3.3, which is good. But the NASDAQ is doing 7%. Man, go NASDAQ. Year to date, the S&P is doing great, 11%. But you see how the Russell is only 2.4, and the Dow is 3.7. The Dow is more acceptable because this is like older companies that are, paying dividends and they don't move a whole lot, more stable. And the NASDAQ's just flying, man. 13.88%. Awesome. So it comes back to, is the Russell 2000, these small caps, are they going to be held back forever? No. I think there might be some value there that is interesting to invest in. I think as we evaluate companies on the live streams, we end up looking at companies with great fundamentals. They have really good earnings growth, revenue growth, cash flow, and they're small caps or medium caps. Most of them have been small caps. And it fits into the theme that the Russell 2000 is made up of small caps, mid caps, and it hasn't kept up with the other indexes. So I think that's going to recover at some point, especially as we see interest rates fall. That's what helps small caps. And I think they're going to rebound at some point. The other thing that we'll look at is sectors next and industries. And that could be another area of finding discounted stocks. Every single market, no matter how good or how bad it is, obviously in a bad market, it's easier to find discounted stocks, but no matter what market we're in on an up market, you can always find discounted stocks because certain sectors or industries are somewhat left out because it's perceived that, hey, those are bad right now, but they may be really good in 6 or 12 months. And as a value investor, I'm good kind of looking for what's going to be next. Where is the market going to start to rally in 6 months or 12 months? Just to look at today's trading, right now, the Dow is up a little bit. S&P is up 0.36. So the rally is fading a little bit today. Then the Russell is rebounding. The Russell had a terrible day yesterday. So it's good to see it rebound. You can see that the Russell is in dark blue. It was down quite a bit yesterday. and now it's up. So that's good. All right. So those are the indexes. So the question that I wanted to start off with is, where do we find discounted stocks? I mean, the market's priced expensive, in my opinion. So where can we find them? Well, to begin with, let's kind of look at sectors. And sectors are made up of industries. So just to kind of drill into financials, within financials, you have banks, you have financial services, you have insurance companies. Those are different industries. And you have maybe 10 different industries within financials. But what I'm looking at here, and I've got your comment, Mike. Cool. Yeah, thanks for the comment. I'm going to get to your comment because it kind of aligns with something I'm going to talk about in a minute here. But thanks for the comment there. We're going to talk about REITs. We're going to talk about real estate. And looks like I'm constantly DCAing my REITs. I'm looking for a great return 3 to 6 months out. I agree with you. And I'm going to get to that comment. Let me kind of continue my stream of thought, and I'm going to get to you. So as we look at these sectors, Mike's talking about real estate. And within real estate, you have different industries, right? You have home builders, you have commercial properties, you have multifamily, you have all kinds of different sectors. When we look at these sectors, we could say, okay, which sectors have been doing really well this year? Well, you probably guessed it, technology. Technology is doing great. Communication services, that's where Meta, Alphabet, Netflix reside. That's doing really well. Utilities have had a really nice increase this year. And then industrials. Industrials have been kind of a little bit of a surprise, but not, and it tells me that the economy is doing better than maybe the numbers are telling us, because industrials usually go up when there's industrial output, there's industrial growth. So that's really good. Healthcare, I think healthcare, you have to be a stock picker or had to have been a stock picker to get the really good gains. If you were in the weight loss drug stocks, you're doing great. Some others are doing really well, but some have been beaten down. Like Pfizer's been beaten down. CVS has been beaten down. Financials, okay. And consumer staples, energy. And way down here is real estate. To Mike's comment, is real estate going to be held back forever? No, we need real estate. There's only one earth, and they don't make more real estate anymore. So although higher interest rates are putting a downward pressure on real estate, and I would agree that like office commercial is probably dealing with a lot of big problems, which is people don't go to the office as often. I get that. Outside of that, if you look at multifamily, if you look at, like, I'm in a couple of REITs that that own healthcare related properties. I mean, healthcare isn't going to go away. It's not going to go away whether we have a good economy or a bad economy. So if you pick certain real estate investments, I think you're going to do okay. You got to be careful though, because certain real estate is pretty bad. Commercial, I wouldn't touch commercial office. I'm just not smart enough to touch it. I invest in individual properties that I rent out. These are residential properties. I rent them out to people directly. I own the properties. I rent them out to people. That's part of my overall portfolio. I rarely ever cover that space. But since we are talking about real estate, if I were to put my net worth, out there, most of my net worth is tied up in real estate. So I'm a believer in real estate. If you buy it at the right times, you'll make a lot of money. Real estate, I started investing in it big in 2010 when nobody wanted to touch it, and it really paid off for me. What I see is that real estate is really certain spots, very attractive acquisition prices that, especially for an income, based kind of investor that, hey, I want a nice dividend, really good category to take a look at. So really good idea there on REITs. Be careful on what REITs you're buying into. Make sure you always understand, what you're getting into there. So again, back to the topic of where do we find good discounted stocks? I think going through and saying, okay, well, what industries are going to bounce back? So we just talked about real estate, materials. As the economy improves, materials will improve. Is that potentially a good space? Well, over the 5 years, it's had a good return. So maybe buying into companies that materials might be a good idea. Consumer discretionary, I always find this is a very confusing sector because there's all kinds of different companies. So you have to be very selective. I'm very selective on the companies I invest in, but potentially there's good value there because they haven't kept up with, where the leading sectors have performed. Energy, if you buy energy at the right prices, it's always a good investment in my opinion. And then consumer staples, I'm not overly excited about consumer staples. I think they're good to have, but I don't know that we're going to go into a recession. So I don't know that I'd touch that. Where I have been a big investor is financials and healthcare. So I'm betting big on both. And these financials have already started to work. And I think there's more value there. And I think there's more companies to find there. I think as we looked at companies on the live stream, a lot of insurance companies were showing that, hey, they have a lot of good earnings. They have a lot of good growth. The fundamentals look great. But I look at banks and I think the same thing, which is, hey, they've got really good fundamentals. I look at companies like PayPal. I look at companies like Coinbase, Robinhood, very good value proposition. So I'm bullish on financials, and I'm also expecting that healthcare is going to rally, especially like smaller pharmaceutical biotech companies. They're going to have their day in the sun, and they've kind of been ignored a little bit because technology's just been such a superstar for the last 2 years, right? NVIDIA deserves all the attention they're getting because they're just freaking on fire. But that tends to take everybody's eyeballs and put them on technology. Well, I think that healthcare, some pharmaceutical and biotech companies are discounted, and it's just a matter of finding the right ones. Once you get through, looking at, hey, okay, I know roughly like a sector could kind of get you, to use an analogy, to the right city, but I'm looking for the right neighborhood. And the right neighborhood within that city would be the industry. And you can continue to drill into industries and maybe pick out some industries that are interesting to you and that you understand, and maybe that have been left behind. For example, if we look at year-to-date change, pharmaceutical retailers, CVS, really beaten down. Broadcasting, I'm not sure I'd invest in a lot of broadcasting companies because I think Netflix and the other streamers are taking them out, as well as YouTube. Here's real estate again, right? REITs. So there's kind of a way to kind of find veins of value if you kind of do some homework and start looking at it, kind of look at a high level strategic view, kind of look at the whole market if you can, and then start drilling into veins of value within the market. So that's, I try to do this every month. For sure, every quarter is really understand and make my assessment on, hey, what's going to be really good in 6 months, 12 months? And let me think with that kind of mindset. So that way I could find something that maybe I have to sit on it for 6 months, 12 months. But then when it starts going, and it really, gives me a nice return. All right, good stuff. So I wanted to kind of get our thinking hats on for that piece there. Now let's talk a little bit more. Mike showing up with some comments. Thank you, sir. No office REITs. I agree with you. I'm not quite sure what's going to happen to that market. And if I don't know, I don't invest. I agree. Healthcare, energy. Yep. So I think, every market, I know it's a little bit of an expensive market. It may seem daunting, like, man, where am I going to find value? But you can. Every market will provide it. There's thousands of stocks to choose from. Not all stocks go up consistently the same level or go down. We have an expensive market, but I think some stocks are being discounted. They're being left behind from this rally. All right. So, Mike, I tried to get in PLD, but it never hit my price. Maybe one day it will. MPW, Vici, O is I think Realty Income, ABR, MAA, and several others. Awesome. So you're in REITs, and MPW is high risk in my opinion. I think they're doing okay. I think their earnings kind of made a lot more people more comfortable with them, and they're going to pay a dividend, which is very good. Vici is a good company in the casino business, and I mean I think Vici is a good one. And then Realty Income, I've looked at it, and they do more like uh, retail and like restaurants, and maybe not the big malls, maybe the smaller open air shopping centers. They have a very high quality portfolio, but I would be a little bit scared of some of the retail. Retail is just a tough business. Don't need to convince many people of that. Income stocks like SVOL. I haven't heard of SVOL. Simplify. So this one here, volatility alternatives, huh? Interesting. All right. So let's Plex Avalanche. Thanks for tuning in. What's your take on ASML and MAAT? Let's take a look at those. I haven't looked at SAML in a while, but they are a big, important company. They're a big cap, 371 billion. They are located down in the Netherlands, and they develop the machines that semiconductor companies use to produce semiconductors. These are massive machines. They're really expensive, but once a company owns it, they can produce, the semiconductors. And they are, I think, a market dominant company. So when you look at this company, they dominate this particular industry. So a very strong company, which is why they have such a strong market cap. They're a $28 billion company. All right. And they pay a small dividend, 7.79%. They have a high forward PE. And if we look at their stock for the last 5 years, it's done well, 389%. It had a nice acquisition price like many stocks in 2022. And then back in 2023, when a lot of stocks sold off mid-year, it had a nice acquisition price. And man, that was a really nice price to buy on the stock. You'd be up quite a bit. Now, what's happening is you have the AI hype, and you have companies like NVIDIA just selling, through the roof. And I would point out, my understanding is that NVIDIA is awesome, but it's not a giant volume increase for NVIDIA. It's that their particular semiconductors and GPUs, they cost a lot more per unit. Now, ASML produces the machine, and I would think is more unit based, which is whether the semiconductor is selling for $50 or $50,000 like an NVIDIA unit, it's one unit. So NVIDIA is making a lot of money because their units are so expensive. So are we seeing a semiconductor rise of overall volumes? I don't think so, not yet. If you look at overall units, and you can probably look at TSM as a good barometer for that observation. That's my observation, by the way. Now, what do I think of this company? I think they're a very good company. They've been growing. You can see their revenue growth, very good growth. In 2023, they grew 30%. When we look at the quarterly, they did have a drop in the most recent quarter in revenue. So I would want to know what's going on with that drop. You have this AI boom. You have, NVIDIA going off the charts, as well as Broadcom, and you have AMD. Just they're flying off the charts. Well, where's the volume? Why aren't they ordering more machines and saying, hey, we need more capacity to build more semiconductors? So I'd want this question answered. Why was there negative growth in ASML? Maybe Plex. That would be kind of a, slam on the brakes. What's going on? If we look at, balance sheet, I looked at ASML maybe a year ago, so it's been a while. They have $6.8 billion of cash, debt, current debt 0, long-term debt 4.6. So obviously they can pay off their debt immediately if they wanted to. Very strong balance sheet. And then cash flow. If we look at their free cash flow, it was negative in 2023. They may have been kind of increasing their factory space and so forth. Previous year, 2.6 billion. And I'll tell you that you will not be able to value ASML based on free cash flow and then see that it's anywhere near their market cap. You won't get there. It'll fall way short. Like you'll value 40% of the value of the stock price. Now, if we look at the earnings per share, how many analysts cover this stock? Only 5 analysts. I would have thought that like 50 analysts would cover this stock. This is a big company. And they're saying, hey, it's discounted by 9.6%. They base most of their estimates based on, earnings per share and growth of revenue. And their earnings per share is supposed to freaking grow like crazy. Man, very good growth in earnings per share. So if you valued ASML based on earnings per share, you'd probably get to this share price and probably a small discount. I think they're going to hit these growth numbers. And the reason for it is semiconductor has been kind of in a recession, believe it or not. I know NVIDIA is the exception, but I own Himax, which is a small semiconductor producer. And they were in a recession because their end markets are like automotive and appliances and displays, like for computers, PCs and so forth. And for them, they've seen a lowering of volumes because we have been in a recession within that particular microcosm. So as those particular sectors, really rebound, you're going to see an increase of ordering of these machines. And of course, Intel is going to be creating their foundry here onshore in the US. And I'm sure they're going to order a bunch of machines from ASML. So I think they're probably going to hit this forecast of growth. And that's where this stock price is really coming from, is from earnings per share growth. And that's ASML. I think very highly of the company because they're just they have a very strong position in that space. Investors talk about moats or barriers of entry into their market. ASML certainly has that. As we look at Applied Materials, they also do equipment. I don't know if they're big, but they are pretty big. $184 billion revenue, 26. PE is a little lower. Dividends about the same. Strong buy, but it's priced at a premium based on probably earnings per share. If we look at their cash flow, how does the cash flow? Cash flow is much better than ASML. So the market cap's half as much and the cash flow is far better. So this one would be more attractive to me. And so this one might give me a fair price, probably still be priced at a premium if I use the cash flow to value the company. If we look at earnings per share, let's see what their forecast looks like for growth. Growth is going to be good, not quite like ASML, but it's going to be growing nicely, probably above 10% for the next 4 years. That's great. So if you priced it based on earnings per share, you'd probably see that Applied Materials is going to be a positive stock, and it's probably going to do well over the next couple of years because, again, I think a lot of the markets that produce semiconductors are going to be rebounding. Not the whole world is not building AI. You still have cars, appliances, you have desktop computers, laptops, you have, smartphones, you have semiconductors and like lots of products. I was about to say everything, but not everything quite. But I think a lot of the markets are going to start to bounce back. So, and I think Applied Materials might be in a good place. Let's see where their stock's been. It's been doing great. If we look at year to date, it's been doing phenomenal. All right. It's been a winner, but I think it's going to keep going because there's a lot of factors that I think are going to continue to push it forward. All right. Good question there. All right, Mike, SVOL pays 16%. Yeah, I'm gonna look into it. I'm gonna take your advice on that. Thank you. Demetra, Snowflake, and then BWXT. What do I think of them? So let's go over Snowflake first. I am familiar with Snowflake. And you know, I've covered technology for some time. When they first came out and they came out with their proposition, I thought that it was, I was a little bit surprised and impressed that they opened up and were as valuable as they were. But I think that there's a lot of software companies that could replace Snowflake. You have giant software, because Alphabet in a way competes with Snowflake. You have a list of companies like Microsoft competes with Snowflake. Now, can Snowflake carve out a really good space for themselves? Absolutely. But it depends on, what kind of valuation and value proposition they're offering. They're a $52 billion market cap. Obviously, they've come down quite a bit. For the past year, they're up 3%. Year to date, they're down 20%. If we look at, why are they down? They're a $2.8 billion company. So you're paying, oh man, like, I guess I'm going to say like 25 times. No, that'd be too much. About 20 times revenue. They are not profitable yet. Their forward P is very high. So it's all about growth. How are they doing growth wise? We look at their growth for the year is very good growth on a low number relative to, they just started their business 5 years ago, it looks like. But if we look at the quarterly, maybe that's where, no, the quarterly looks really good. So revenue is nice and high at 31%. So this is a growth stock and investors would invest in it because of growth. 36 analysts cover it. They say it's a buy and they say it's discounted by 32%. We look at the earnings per share. It's supposed to grow modestly, like grow 4%, 9%, and then drop in 28. That's interesting. Why is it going to drop? That's a big drop too. So this one here, so Snowflake is not an investment for me. I don't believe they produce free cash flow yet, or if they do, it's low. No, they do produce free cash flow. 778. If I took that number and they are a growth company, so let's say I multiplied it times 30, I'd probably get to about 2.1 billion to 3 billion in value, 21 billion to 30 billion in value. And I wouldn't be able to value this company based on cash flow up to the level where they're at. But other investors might, strictly look at earnings per share growth, margin growth, and that's the right investment for them. It's not the right investment for me. I think once a company really starts to be valued based on free cash flows, that company is really going places. It's no surprise, right? You look at the most valuable companies on the stock market, and we'll look at market cap, right? Microsoft, look at their free cash flow. Apple, look at their free cash flow. Look at NVIDIA's free cash flow. NVIDIA did $15 billion of free cash flow in the first quarter of 2024. That's why these companies are worth what they are, is because they produce free cash flow. They're growing it. Revenue tells us that the company's growing, that their products are really good. But free cash flow tells us, hey, these guys, they get to keep a lot of the money on that top line. You can have a company like Walmart. We looked at Walmart a couple of days ago. Great company. But Walmart only keeps like cents on the dollar. Like they sell a product and it's like, man, their margin is a little bit, especially online. When NVIDIA sells a GPU, it's like 90% gross margin. If you don't include like the engineering costs and stuff, it's just great margins. And that comes down to the cash flow. So that's why Snowflake's not the right investment for me, but it might be the right investment for other people. Let's take a look at BWXT, which I've never looked at. So this company, BWXT Technology, together with its subsidiaries, manufactures and sells nuclear components in the United States. Very interesting. So nuclear is making a comeback. I know in the US, people are freaked out about nuclear. Oh my God, nuclear is dangerous. And in fact, it's not, right? If you look at Europe, France, for example, they produce most of their power using nuclear. You got Japan producing most of their power using, and you have few incidents. Yet, with the way that we produce power in the US, we're willing to burn coal and pollute the air to produce power, right? But hey, we don't want to go nuclear because it's dangerous. Um, that's changing. I think people's understanding and perception of nuclear has changed quite a bit in the US. So I would say from a very high level, this is a pretty good space to kind of look at. We look at this company, they've done 80% over 5 years, 37%. They've had a drop recently, but this is another company I'm going to kind of note. Market cap's 8 billion, nice small market cap. You're not paying that much for the company, less than 4 times for their sales, and small dividend. Forward P isn't too bad. How are they doing on growth? Growth is okay. 11% is really good, almost 12. We look at the quarterly, 6%. That's not bad. This one here is kind of a really interesting stock to me because they're tied to energy. Energy is going to be in demand for the next, I don't know, 1,000 years. We can't run the computers or everything without electricity. Okay, so revenue is looking decent. All right, so cash flow, net cash flow is $212 million for the last full year. Looking at the quarterly, free cash flow did drop to 2.6 million. It might be a seasonal thing, but that'd be something to look at. So 212, it is growing a little bit. So I'm going to multiply times 25 just to get kind of in the ballpark. 25 times 212 is going to get me about 5.5 billion. So I'm not quite there on a valuation. I'd have to look at it closely. Let's look at their forecast for revenue. So their revenue, 7 analysts cover this company, and they're saying, hey, it's discounted by 4.5%. And that's because their earnings per share has been consistent, and it is going to grow. Wow, that's nice growth. That's really nice growth. So earnings per share wise, this is a good company. And I think that's why their stock price is where it's at. You'd see it in a really nice rise, is their earnings per share is really growing. Just the free cash flow is a little light. But I'm still going to look at this because I like to look at companies where I really do believe in that space. And maybe one of their competitors might be better to invest in, or maybe this one's kind of a good stock to watch and wait for the stock price to drop to a good level and then buy it. So thanks for the idea, Dimitra. All right. So they sell machines. Yep. And we're talking about ASML. Totally understand. And they have a very strong position in that market. And I think overall the demand will continue to come for semiconductors. Semiconductors are being put into all kinds of things. All right. What's your take on Dell Technologies? So, I'm not a big believer in Dell Technologies. And the reason for it is Dell is, and it's just one person's opinion, one investor's opinion. But I've been investing in technology companies for 30 years. And the technology companies that I love are those that really hold patents and barriers of entry into their particular micro market. Things like, for example, NVIDIA's GPU technology, right? Nobody can use it right now. They can't copy it and then start using it because then there'd be patent infringement and they'd keep them out. And in the case of Dell, I don't know that they have a lot of patents or ideas that are not repeatable. They started their business, creating desktop PCs and then went to PCs or laptops. And, from there they did servers and so forth. And those servers are maybe in a little bit more demand, but we'll go into their financials and I'll kind of see if my high level logic is consistent with their financials. So I think they're getting a bump because everybody's crazy about AI right now. Oh, AI is going to be awesome. And maybe it will be. But the companies that are going to keep the value are going to be the companies that have the best patents, that get the best margins. And Dell, I don't believe is in that category. I think they're more of a commodity based, like technology hardware company. When we look at their revenue went down from 22 to 88. Now, in COVID days, right, their revenue went up a little bit, but I'm sure everybody started refreshing their PCs and they saw a big bump in 21. But in 23, why is their revenue going down? Why is their revenue going down and their stocks going up at the same time? Riddle me that, Batman. How is that possible? It's the AI hype. And uh, so their revenue's down. Looking at the quarterly, maybe their quarterly's off the charts. Nope, quarterly's bad. So revenue's down, which means lower volumes. Okay. And that's what I'm speaking to is these guys are a commodity hardware company. When we look at their free cash flow, maybe they're creating free cash flow that's off the charts. Nope, 800 million, 1.4 billion, 2.5 billion in that peak period, right? But before that, it was just 1 billion, 2 billion, negative cash, negative cash. So I'm trying to take a company that's going to produce $806 million in free cash flow, and I'm trying to substantiate $118 billion valuation. Can't get there. Can't even get close. When we look at the forecast, 15 analysts are saying, hey, you ought to buy this. It's a strong buy, although you're going to be paying a premium of 27%. How's that possible? Hey, these guys are recommending that I buy a stock, and they're also saying that I'm going to lose 27% of my investment. So I'm not a believer in the commodity hardware space, is my opinion on companies like Dell and anybody else like Dell. I'm an owner in Hewlett Packard, and it's the Hewlett Packard consumer part of Hewlett Packard. And the reason I buy into that stock, very well run, and I bought at the right price levels, and I'm sitting on a really nice gain. That's a nice long-term hold, but that's, I think Dell is both consumer and business or commercial uses of technology. So that's my take, ZK. Hope you found it interesting. Good luck with that. All right, cool. Dimitra, hey, thank you for showing up and providing that comment. I really appreciate it. I think, there was a couple of stocks that I wanted to cover. One of them was Qualcomm. And, Qualcomm, it's interesting to see that, back to my earlier message of, hey, you can always find value even though a market is really expensive. And I started buying into Qualcomm during this range, So when I saw NVIDIA just fly off the charts, and I'll try to chart this really quick. So NVIDIA didn't show up last week and, start, rocking and rolling. In 2022, they were discounted, and then they started just flying up, right? Awesome. So when I saw this, I just couldn't value NVIDIA right, and I didn't get into it. But what I did find was that Broadcom was a really good buy. So I bought a big position in Broadcom, and now I bought into Qualcomm. Let's kind of chart those. So you could see that, hey, NVIDIA is really just, their chart's so crazy that, I can't keep up with it. But around a year and a half, 2 years ago, I thought, okay, well, how could I find a peer to NVIDIA that I can invest in? Because NVIDIA seems so expensive. And if they're going to do really well, maybe one of their competitors will also do well. And I found Broadcom. So let me go switch over to Broadcom and just compare Broadcom and look at Qualcomm. So if you look at this company, I started buying them in this era, and it really was a great winner for me. And then I sold it toward the end of 23, and I didn't participate in this kind of like last 30% of gains, but I sold at a really nice gain leading up to that. So I'm not crying in my soup. I did really well. Sold about $80,000 of Broadcom. Thank you very much, Mr. Market. And I saw the stock continue to go up. Is it kind of fun to watch it go up? No. But at the end of the day, I wasn't greedy and maybe I sold too soon. Who knows? We'll see where the stock is in about a year. Now, the same mentality of, okay, NVIDIA is flying off the charts. Broadcom did really well for me. So I started looking into Qualcomm and realized, you know what? Qualcomm is kind of getting beat up. And if you look at their stock chart, right, they're really beat up. This is when NVIDIA is just flying up and to the right, just flying up, and then Broadcom's flying up. This one was left way behind. So this substantiates kind of those comments I was making, which is, hey, no matter what market, there's always a discounted stock out there. And here was the discounted stock that existed in, let's call it the October timeframe. So I loaded up on this stock and I'm sitting on a good gain. You know, I think I'm sitting on $20,000 of stock. I invested, I don't know, 14,000. So I'm sitting on a nice gain. And that's kind of, you know, my game is, you know, find a good value stock and buy into it. Recently, and what was going on that drove the stock price down is that, as you recall, Apple was saying, hey, we're not going to sell as many units. One of the principal customers for Qualcomm is the Apple iPhone, as well as Samsung devices. But now they're saying we're changing the forecast. There's going to be more devices sold in the future. And Qualcomm is becoming one of the chip makers that's going to go into the new PC refresh that's going to actually run some of the AI applications. So we'll see what happens with Qualcomm, but that's kind of like, you know, I've been successful in semiconductor. I just didn't buy NVIDIA, and Qualcomm's the latest and greatest within semiconductor. In the last month, it's up 28%. So just wanted to highlight Qualcomm. I have a full video on my channel. If you want to search my channel for Qualcomm, you can see that full video and check it out. So next comment is from Plex Alanche. I think HVAC would be good. So HVAC. So this is, I'm not sure I'm looking at the right company. So is this the right symbol? HVAC? I'm not sure about that. But thanks for the comment. So a couple other stocks to just put out there. Let's see if Zim's doing okay. Zim was up quite a bit this morning. Yeah, it's still up 6%. This stock's really doing well. For the last month, probably is the chart to look at. It's 80% in the last month. Year to date, it's up 9% because it had just been beaten down. It had a really nice high, and then it went down. Buying at the right time on this stock is really the key, and it's up nicely. Yeah, heating, got it. Okay, so now I think you're talking about the space. You know, I agree with you that HVAC for air conditioning and heating and so forth, that's always kind of consistent demand because frankly, you know, we're going to need heating and air conditioning. The one thing that would be a big factor is construction. Like, are we going to be constructing a lot of new buildings, a lot of new construction, which is going to drive demand for HVAC? That would be one of the items. And I'm not sure that that's going to be the case going forward because high interest rates tend to put downward pressure on construction because construction loans are more expensive and it's more expensive to do these projects. So that's one thing that I'd be concerned about. But I think picking the right company, that would be more of a Dow-based stock that isn't going to move very quickly up or down, and it's probably going to pay a dividend. All right, so good question there. And then probably the last company I'm going to cover I made comments earlier about, you know, life sciences companies. Here's Harmony, right? So you look at the stock chart and you go, wow, this company is kind of troubled, right? It's been selling off, especially over the last year. And it had a really big low here. The stock price went down to $20. So when we look at the financials, I'm expecting, wow, this company is in real trouble. But actually, the financials paint a different story. They're a growth company. They're not big. They're small. And I think that's part of their problem is they're small cap, but their forward PE is nice and low, 12. Analysts are saying it's a buy and it's 49% discounted. When we look at their financials, you're like, okay, they're growing. So why is their stock price tanking? They're still growing in the quarterly. Very good. When we look at their free cash flow in the quarter, and free cash flow in the year. So when I value this based on free cash flow, I get a huge discount. So look at the earnings per share discount, earnings per share forecast. Earnings per share are going to grow really fast. So this company here is producing drugs that help people with neurological conditions, and they have a addressable market that isn't massive, but they're really successful in that space, and they continue to acquire other businesses to diversify their product offering. But that's a little example of a small cap that is really being left behind, but I think has a lot of stored value. If you look at their balance sheet, they have a lot of cash on the balance sheet. So just a lot of things that I like seeing in an investment are represented in Harmony. If we look at their cash equivalent, 353 million, debts 15 million plus 178. So they can pay off all their debt and have a lot of cash left over. Meanwhile, they're producing more free cash flow. So they could be around forever. They could be acquired by a bigger pharmaceutical company that's like, hey, there's a lot of value here in Harmony. If they acquired the company, they'd probably pay a nice premium on the stock. So this is a stock that I am buying into. I don't have a big position, but I'm going to be buying into it, just forming maybe about a $10,000 to $20,000 position in Harmony, because there's a lot of stored value, and there's probably like a good number of companies in healthcare and pharmaceutical and life sciences that look like this. And the reason for it is the investors that typically invest in growth are really, their attention's on technology. Where could I find the next NVIDIA? Which it kind of makes sense, right? It's human nature. People really are attracted to the superstar stocks. NVIDIA deserves all the attention. Meanwhile, there's stocks that are just performing great that are being left behind. And I'm a value investor where I love discounts, and I'd rather buy into a company before everybody else recognizes it and watching it take off. So that is a stock that I would suggest out there. Just a quick reminder, I'm an individual value investor. Just share my experience and my opinion on stocks. I'm not recommending you buy any stock that I covered, not recommending you sell any stock that I covered, and I provide no financial advice. So thanks so much for tuning in. I really appreciate it. Everybody have a really nice weekend and good luck with your investments.